Howdy, everybody. Welcome to Liberty Call. Today is, what day is it? Thursday, January 18th, 2024. Hope everybody's having a fantastical day out there in the interwebs. It is a overcast and dreary day here in Colorado. It is like 33 degrees, but we shall muster on, I guess. I couldn't think of anything clever to say. So anyways, like I said, hope you're having a good day out there. It is a little chilly here. But I was just outside with my pup and getting the mail and just farting around out in the front yard. And he was running around through the snow. And anyways, all right. If it is your first time watching Liberty Call, you are here to learn about what happened in the markets today, right? Right? Am I right? Yes. If you could do me a favor, it is your first time. If you could give me some thumbs up, like, share, subscribe, follows, and press the notification bell because you want to know when I go live. All righty. Let's go ahead and get into today's numbers. Dow Jones was up 0.54%, 201 points. It was in the red most of the morning, closed at 37,468. S&P 500 was up 0.86%, closed at 4780. NASDAQ up 1.35%, closed at 15,055. The VIX fell 4.46% today. It's down to 1413. Canada was up 0.3, Brazil was down 0.77, and Mexico was up 0.06, so it was flat for the day. Germany was up 0.83%, the UK was up 0.17%, France was up 1.13%, Netherlands up 0.87%, Spain up 0.13%, Italy up 0.84%, Switzerland up a third, and Portugal flat at 0. Russian exchanges both in the red today. The MOX down 0.2, the RTSI down 0.42. And the overnights, the Nikkei in Japan was down 0.04%. Australia down 0.63. New Zealand is at 0 right now. Let's see. The Shanghai in China was up 0.43%. The Shenzhen component up 1% even. China A50 up 1.59%, DJ Shanghai up 0.67%, Hang Seng up 0.75%, and the Taiwan weighted up 0.38% for the day. Exciting stuff. It seems like markets are in a little bit better mood today. I mean, there's always tomorrow, quite frankly. So, all right, let's go ahead and move over to the market recap. U.S. stocks rise as Apple chip stocks lead tech higher. All right, get my notes. 1, 2, oh, hang on. I did not get the last of my notes up here on my screen because don't want to do that because then, let's see, was this the right one? Sorry, folks. Yeah, that's it. That's it. Copy. Paste. There we go. All right, let's go ahead and get into the recap for today. Let me get back over here. All right, U.S. stock futures experienced a notable increase fueled by a rally led by Apple, which overshadowed tempered expectations for aggressive Federal Reserve rate cuts. Apple shares rose over 2% after Bank of America upgraded its rating from buy from neutral. The optimism stems from the anticipated demands for the latest hardware supporting artificial intelligence features in iPhones, potentially driving upgrades from earlier models. Bank of America also expressed confidence in continued growth in Apple services, particularly in areas such as advertising and health and fitness. As a result, the price target for Apple stock was upgraded from $225 from $200 even. Other tech giants joined the upward trend, with Alphabet, Google's parent company, gaining nearly 2% as investors reacted positively to reports of potential job cuts aimed at streamlining operations. Semiconductor stocks, including AMD, NVIDIA, and TSM, saw increased favor, with TSM surging over 8% after delivering positive quarterly results that exceeded Wall Street estimates. In economic news, initial jobless claims dropped by 16,000 to 187,000, reaching the lowest level since September of 22. This data suggests ongoing strength in the labor market, dampening expectations for an aggressive rate cut by the Federal Reserve in March. Atlanta Fed President Raphael Bostic adjusted his timeline for rate cuts, moving it to the third quarter of 2024, citing unexpected progress in inflation and economic activity. However, not all sectors experienced positive developments. Discovered Financial Services saw a 6% drop in its stock value after reporting a substantial drop in fourth quarter net income, partly due to increased compliance-related expenses. Ooh, those evil compliance people. Regulators make everything expensive in the financial world. Health insurance company Humana Inc. also faced also faced challenges, falling 9% to a 52-week low after cutting its annual profit outlook, citing higher medical costs. Well, it is a hospital. In the energy sector, stocks rebounded following an increase in oil prices, driven by optimism about stronger demand. The International Energy Agency revised its growth forecast for oil demand, projecting a rise of 1.24 million barrels per day in 2024, an increase of 180,000 barrels per day from its previous estimate. Additionally, U.S. crude inventories fell more than expected, contributing to positive sentiment in the energy markets. Yeah, I get those alerts all the time on my phone, when the, whatever economic data comes out, whether or not it's jobs or crude numbers. And it seems like, the forecast for crude is, let's say this week is supposed to be a drawdown of, I don't know, we'll say 2 million barrels. Then they have a surplus of 8. And then the next week they think, or next time the report comes out, they think, well, we're going to have a surplus of, say, 3 million barrels. We have a deficit of 7. It's like they're never correct, which is just it totally blows my mind. So, anyways, all right, let's dive a little deeper into the jobs and stuff. U.S. weekly jobless claims at 16-month low. Home building takes a breather. The number of Americans filing new claims for unemployment benefits dropped unexpectedly last week to the lowest level in nearly a year and a half, indicating ongoing strength in the job market for January. The Labor Department reported a decrease of 16,000 initial claims for state unemployment benefits to a seasonally adjusted 187,000 for the week ending January 13th, marking the lowest level since September of 2022. This unexpected decline, coupled with robust retail sales growth in December, paints a positive economic picture and may complicate the Federal Reserve's potential interest rate cuts in March, contrary to market expectations. I've been saying this for a while. Do not expect the Fed to cut rates here in the first quarter. And, Mr. Bostic said, don't expect them until the third quarter. The data supports the notion of a tight labor market as companies remain cautious about laying off workers in wake of financial challenges in finding labor during and after the COVID-19 pandemic. While claims data can be volatile around the turn of the year, economists suggest that the mild seasonal layoffs may be indicative of the genuine tightness in the labor market. Unadjusted claims decreased by 29,543 to 289,228, with notable drops in New York, Michigan, Pennsylvania, Wisconsin, South Carolina, Georgia, and Minnesota. The unexpected strength in the labor market poses a challenge to expectations of a rate cut by the Federal Reserve in March. Federal Reserve Governor Christopher Waller mentioned this week that the economy is, quote, doing well, and that's in quotes, providing the central bank with the flexibility to move carefully and methodically. Financial markets have reduced the probability of a rate cut at the March policy meeting to below 60%, according to the FedWatch tool. The claims data covered the period for non-farm payrolls component of January's employment report, suggesting continued strong job growth this month. The continuing claims decreased by 26,000 to 1.806 million. The lowest since October. More insights into the labor market in January will be available with data on the number of people receiving benefits after an initial week of aid, scheduled for release next week. So jobs numbers look good. Again, I've been saying this for a while. The economy, as long as I don't think the Fed is going to do anything until there's a reason. And I think that's why they're holding off just lowering rates, because to just lower rates, they'll lower them by a quarter, maybe 0.5% over 6 or 7 months. But we're at normal right now. So the only reason that they would go back to zero is if something bad happens, which I think they expect something bad to happen. And that gives them the excuse to be the Lone Ranger riding to the rescue and say, here's a bunch of money, here's a bunch of low interest rates. See how we helped you. And then we're going to go through the same process that we've been going through cycle over cycle over cycle, just postponing the inevitable. Anyways. All right, one last article here. It's going to be a most turbulent year for stocks. This was authored by Simon White from Bloomberg. He's a macro strategist. Let's see what he had to say. In the face of potential Federal Reserve rate cuts, the long-duration, tech-focused trade is showing signs of vulnerability, while low-duration sectors like energy, utilities, and small caps and value are becoming more attractively priced. Bloomberg macro strategist Simon White warns the Federal Reserve rate cuts could amplify existing inflation pressures. I just said that. putting duration-heavy portfolios at risk. Each rate cut, while addressing short-term issues, may contribute to a larger problem of reaccelerating inflation. While advocates for anti-fragile portfolios that can navigate the shifting landscape by reducing duration risk in response to falling rates and taking advantage of increasingly cheap, low-duration sectors, the expected knee-jerk move higher in tech and similar sectors as rates fall can be used to reallocate portfolios strategically. Because when rates go down, things like tech, which are highly valued on future valuations, the lower the interest rate, the higher the future valuation. That just makes their numbers look better. The strategist suggests that 2024 might bring turbulence to the trend in U.S. equities, particularly in the tech sector, which enjoyed strong tailwinds in the latter part of the previous year. The Barron's Roundtable predicts a modest year for the index with a range of -5 to +5%. However, beneath the surface, there could be a significant shift as inflation resurfaces, leading to a move away from tech towards lower duration sectors. Potential risks to stocks include a reacceleration of inflation, less favorable liquidity conditions, overvaluation of tech, and the over-ownership of the sector. Lower duration sectors such as energy and utilities appear relatively cheap, under-owned, and non-consensus, making them more attractive in the current market environment. In conclusion, White emphasizes the underpriced risk of a return of inflation for duration-heavy portfolios, urging investors to restructure their equity portfolios towards lower duration, undervalued sectors to mitigate risks and navigate potential market uncertainties in 2024. Certainly not bad advice. If you're overly invested in tech, you might want to reevaluate things because, I mean, unless the Fed goes and slashes rates to zero, I just don't think tech is going to have the same tailwinds that they had the last year. I mean, the inflation bubble is going to burst, and I think they're probably going to take it the worst. So anyways, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.